Okay, welcome to my support resistance course. So first things first here. So we're going to go over how you can identify support resistance, like what it is, and we're going to talk about how you can use it, of course. But I'm also going to give you some tips on how to make it higher probability, right? So let's start off with the bare basics here. What is resistance? Well, resistance is an area where price has failed to move higher in the past. Support is an area where price has failed to move lower in the past, right? So like, for example, prices, look, it's ripping up, it's ripping up, it's ripping up, all right? It's consistently putting in higher lows. It's consistently moving up higher. So it's in an uptrend, right? And then boom, it has a big move lower. That makes that a clean level of resistance right here. And even these little short-term highs right here are short-term levels of resistance as well, of course. But what resistance is an area where price has failed to move higher in the past. That was the absolute high that price hit before it declined and it moved lower. And then of course, support is the same exact thing. It's an area where it failed to move, where it failed to move lower, right? So you can see on a price chart what it looks like right here. We can see, look right here where my cursor is. See, we have our highest high in the middle, lower high to left, lower high on the right. That makes that a swing high level. This was the absolute high that price hit on this rally right here before it declined to move lower. That was the absolute high. That makes that a level of resistance right there. Even this right here, highest high in the middle, lower high on the left, lower high on the right, makes that a swing high. That's the absolute high that price hit before it declined to move lower. Right here, highest high in the middle, lower high on the left, lower high on the right. That's the absolute high that price hit before it declined and it moved lower. Same deal right here. Okay, because you can see this is it's in bearish market structure. It's consistently putting in these short-term highs. These are also short-term. These are also levels of resistance as well. See that? And then support, you can see support is it's just the opposite. It is an area where prices failed to move lower in the past. Like for example, we have, look right here. This is the absolute low that price hit right here before it moved to the upside. This is the absolute low before we have a bunch of bullish activity coming through this play. That makes that a level of support right there, okay? And what you also need to understand is resistance when broken becomes support going forward. And support when broken becomes resistance going forward, okay? So for example, let's say we have price ramp up, right? And let's say it puts in this high right here. That's a level of resistance, the absolute high right there, up. Look at my cursor right there, boom, the high that we just put in, that's a level of resistance. But what you also need to understand is whenever resistance is broken, like say price ramps up, right, and it just climbs higher and it pushes above that high, it's now support going forward, okay? That resistance when broken, support going forward. So once price returns to an old level of resistance that's broken, you then look forward to reclaiming the support, and then that is how we establish that uptrend is now forming and we're putting in higher lows now, right? And then it's the opposite for support. So like, for example, whenever support is broken, like remember, what is support? Support is an area where price has failed to move lower in the past. So this is that area where price failed to move lower, then price pushes up. And what happens next? Boom, floor gives out. It ramps lower and it cracks that old low. You then look for that old low to serve as resistance going forward. And then that's where we we see that the consistent downtrend, right? That's what you look for. Okay, so there are several different ways you can use support resistance, right? And we're going to go over all of it in this video, but let's start off with the first one that I was talking about. So what did I say? I said what is a level of support? Support is an area where prices failed to move lower in the past. All right, so let's just say, for example, we got this. Actually, let me go to a higher time frame real quick. Actually, so let's start with this right here. So on this Euro USD right here, what did I say resistance was? Resistance is an area where price has failed to move higher in the past. So look right here. We have our highest high in the middle. We have a lower high on the left. We have a lower high on the right. That makes that a level of resistance, right? Because if we were to rewind this, this is an area where it failed to move higher and then it moved lower. It declined in prices. This is the absolute high of the most recent rally before it declined and it moved lower. That makes that a level of resistance, but it's also what? Well, above resistance, what you need to understand, above resistance is buy side liquidity, okay? So we have this high right here. There is buy side liquidity resting above that level right there, okay? Meaning stops, buy stops. So individuals who are short and are looking for lower prices, they're going to have their stops above that level because it's a level of resistance, okay? And what do we see happen next? Price comes up and it takes that. So what a lot of people will do is, or how a lot of people trade resistance is, they will keep their stop above this high, right? Because because the thesis behind this is price failed here in the past. It failed to move higher here in the past, so they're going to keep their stop above this high and look for that move lower. I approach it a little bit differently. Okay, there's different ways to trade support and resistance, of course, but here is the first one we're going to go over. So I see a level like this. I see a clear level of resistance, and the first thing that I ask myself is, okay, I understand that traders are going to be keeping their stops above that level. Short sellers should be keeping their stops above that level. That makes that a target. Okay, and if you can't identify the liquidity, then it's going to be you. So I've identified this liquidity right away. I know there are buy stops above this level. Okay. I know there are willing buyers right here. So price is ramping up and it takes it. Price ramps up right here and it takes that level. So you can see now we're on the lower time frame chart, but that was that level of resistance that I was just talking about a moment ago. Price came up and it took out that level. Now it trades above it. And here's the thing you got to understand. It trades above it and it violates that level. So then, somebody may think, okay, well then it invalidates that level of resistance then, since like it shouldn't have traded above that, since it is a level of resistance. So the fact that it traded up above it, it means it's not a good level of resistance, right? No, not at all. So here's what you need to understand. Like I don't really, as well as a lot of people in the SMC, community, right, don't really use support resistance in the traditional case, right? So it takes out this high, but what you need to understand is the market structure here was never invalidated. It's still bearish, and this was simply a run on stops, because we understand that there is stops above these levels of resistance. So what I look for is, I look for it to run that resistance, because it's still resistance. Like that is absolutely a level of resistance right there. It's an area where price failed to move higher in the past, okay? But then there should be buy stops right there. So then I see price come up and it comes back up into that origin of where this price declined previously. So it's still resistance, but it takes out the buy stops. And look how it respected it. Look how it wicked above it right here. Look how it's respecting that level of resistance. And nothing was invalidated when it came up and it took out this level right here. It's still resistance. So then what you can do next is, and this is what I do, is I utilize market structure, and I have an entire playlist, entire series on market structure. If you check my playlist, you'll see it. I recommend you watch my market structure series, okay? Because I'm not going to go too deep into market structure in this course, because it's basically just support and resistance. But what I'll do next is, in this scenario, I will utilize lower time frame market structure. I will look for a shift in market structure, and then I'll look for lower prices off that resistance. That's how I use it. That's one of the ways that I use it, okay? I've identified the level. We got resistance right here. It comes up and it takes that buy side, but it's still resistance. Nothing's invalidated. This is the one thing I really, really, really want you to grasp here. Just because price trades above that level doesn't invalidate it as a level of resistance. It's just sweeping liquidity, but the resistance is still there and it's still valid. It's still a level of resistance. It's just sweeping the buy stops, because look at how it respected it with these wicks. That is because each candle tells you a story, and that's telling me that it's respecting this as resistance. And then guess what? It sells off right here. It has that shift, and then that sets up for a short opportunity, which I did short on Friday because I took it down to this low right here. See that? I was betting on lower prices. I was betting on lower prices because I had this resistance right here, but I also had the market structure to confirm it for me. And then once the change in trend was confirmed and I had that tide moving lower, well, then I can anticipate it's going to sell off. Okay. And that's what happened. And that's how I used resistance in this scenario. Just like I was saying at the very beginning, it was an area where resistance is an area where price has failed to move higher, and it did. This is the absolute high that price hit before it declined and moved lower right here, but then it came back up into it a little bit later. That's how you use it, because we understand price failed here in the past. It could fail here again. Absolutely, that applies. But what a lot of people do, as I was saying, is they'll look for price, like they'll try to get their entry as close as they can to that high and then risk that high. I don't approach it like that. I want to see that high get taken, because I understand that I have willing buyers right here. I understand that that is a sitting duck. I've identified that liquidity. And as I just said, if you can identify liquidity, well, guess what? It's going to be you. Okay. If you can't identify, who's getting taken, then it's going to be you. So I've already identified right away. Okay. I got buy stops. I got willing, there's buy stops right here at this level. That is a level that I want to keep on. That is sitting liquidity right there. And then price comes up and it takes that liquidity, but it's still resistance. It is still resistance. That's what I'm trying to get through your head. It's still resistance. It just even if it takes that level, it trades up above it, nothing's invalidated. But what a lot of people will look at resistance as, they'll see something like that and they'll think, okay, well, it cracked above it, so it's no longer good. Not the case. It's just running stops, but it's still level of resistance, and then you can look for lower prices. That's how we use it. And then I utilize market structure on the lower time frame chart, look for that confirmation, and then you take it lower. That's the thing. I look for that confirmation after it runs that liquidity, after it runs that resistance, and then I look for lower prices on the play. And I do like support the same exact way. Like when I see price run a level of support, it's the same exact thought process that I just gave you right there, but on support. I look for it to run a level of support, and then you look for higher prices, right? Like look right here. You see right here where my cursor's moving? Lowest low in the middle, higher low on the left, higher low on the right. See this? That's a level of support, right? It absolutely is. Let me just go to the replay. This is an area. This is an area right here where my cursor's moving. This is an area where price failed to move lower. This was the absolute low that price hit before we pushed up and we were making higher prices. That makes that support. That is the definition of support. But guess what? We also have sell side residing beneath this level, because whenever price is going to put in this low somewhere and it's moving up higher, what is that going to do? That's going to bait in buyers. And when it baits in buyers, it's going to do what? It's going to create sell side liquidity, okay? Because they're going to keep their stop right here, if they're not a complete fucking degenerate at least, because, you know, if they're going to keep their stop somewhere, right? Where are they going to keep their stops? But everybody basically keeps their stops at the same place, underneath the support, above resistance, depending on whether you're buying or you're shorting. So guess what? We have a clean level of support right here. Okay, it's an area where price failed to move lower. And then what happens next? Price comes down and it takes it. It trades beneath it. And again, what the novice will see is, okay, the novice will see this and say, okay, it's invalidated because it traded beneath that level. Okay, maybe they got stopped out, right? Maybe they got in on this push lower, and then they got in, they bought it, and they risked this low because in their head they're thinking, okay, I want to look for higher prices. I want to look for price to ramp up here. And then if I get my entry as close as I can to this low right here, I'm going to be able to minimize my risk immensely. And then I can look for higher prices. But what I see is, okay, I see willing sellers right here at a lower price. There's liquidity right there, which makes it a target. So I want to wait for that target to get hit. And once it does hit it, it does not invalidate that resistance. When it trades beneath it, it does not, support. It does not invalidate that support. It's just running liquidity. Look how it respects it. That's the key thing here. It respects it. And then you look for the push up. And then again, that goes back to what I was saying just a moment ago. You utilize lower time frame market structure, and then you can look for the push up, right? So you can see it does end up pushing up right here. See that? So again, guys, now we're on a 5-minute chart here, but that's what I do. That's how I utilize this stuff. Is I utilize different time frames. I identify my resistance, I identify my support, and then I look for it to purge that level. It's still support. Even if it trades beneath it, it's still support. And then I utilize lower time frame market structure, which I have an entire series on market structure, man, I remind you. And by the way, I'll leave a link to that playlist on market structure in the video description as well. So in the video description, after you watch this video, in the video description, click, and I have an entire series on market structure that you can watch. Okay. But here's the deal. We come down right here. Look, we take it out. We take out that liquidity, but it's still support. Nothing's invalidated. And then look right here. You get a shift. So you get like, that's a change in trend right there off that level. See that? That is a change in trend. It has all the signatures for a high probability shift in market structure off that support, off that area where it failed to move lower in the past right here. It failed to move lower, had that big ramp up. It comes back down into that origin, and it's going to want to resume if it has the proper stopper and signatures. It comes down, tests that support, reaction, confirmed, pulls back, discount. And now in a case like this, now pay very close attention. In a case like this, you can risk the low. You remember what I was just saying a moment ago? How a lot of people, they'll grab that move lower, and then they'll try to get their entry as close as they can to that low to minimize the risk. Now, I do that as well, but in a different type of way. Let me explain. So whenever we take out liquidity, I need to say take liquidity, and then I get a reaction like this on the lower time frame after you have taken that liquidity right there, and then you get the actual change in trend after taking that liquidity. Then I will keep my stop beneath support, because look right here. This is the absolute low. Look at my cursor. This is the absolute low that price hit before having that push up right there. That's support as well. So But in this case, that makes it a good place to keep the stop because it's already ran the previous liquidity. So in a case like this, you could keep your stop beneath that low, and you could look to get your entry as close as you want to that low to minimize your risk in a way like that. But here's the thing, it needs to take out that liquidity first. That's the importance of utilizing multiple time frames, various time frames. You identify the support, you look for the shift, and then on this on the lower time frame, you can work on getting your entry as close as you want to that low to minimize your risk. You can wait on optimal trade entry. You can wait at as big of a retracement as you want. And then you can do it like that. Then you can risk that low. But you want to see the liquidity taken first, and then you want to utilize multiple time frames and then look for the reaction. That's how you can do it. Now, is there people that will not wait on the react? Again, I'm kind of giving you my perspective how I do it, right? There's people that'll scoop that up, that'll buy that as soon as it's taken out that low, and that's a successful way. You can do it successfully like that. There's people that will just buy it on the first move lower. That is absolutely a way that you can trade as well, but I'm giving you my perspective of how I do it. And that's how you can approach it. So yes, support is, because this is a level of support and it's a place to keep your stop. That is where you would want to keep your stop at. But it's after it has taken liquidity is the key thing here. You want to see the liquidity run, okay? Because it goes back to something that I always say. Wait for liquidity or you will be the liquidity. If you can't identify liquidity, then it's going to be you, meaning your stop's getting taken, right? So I've identified that liquidity, aka that support. It's a key level of support. And guess what? We took it. And then we get a reaction. Pulls back, deep retracement, and then you can keep your stop beneath the low because it's already taking liquidity right here. See that? That's how I use, one way that I use support and resistance, okay? That's how I do it. Now, what's another way? So that was, the other thing I told you was, resistance when broken becomes support going forward. Support when broken becomes resistance going forward. Remember that? So, like for example, we have a level of, let me go to replay. For example, guys, we have a level of resistance right here. Look at my cursor. See that? Where my cursor's moving? Back and forth, highs on the middle, lower high on the left, lower high on the right. That is the absolute high that price hit right here before it declined and it moved lower. That makes that a level of resistance. Absolutely, it makes it a level of resistance. It's an area where it failed to move higher. Then what happens next? See, price comes up to that resistance, but we have a different scenario here play out. You remember what I was talking about just with the previous examples? How we were talking about how to use support resistance in the previous examples, like price comes up into an old high, right? And it tags that liquidity, but it respects it. And then you look for the lower time frame shift, then you look for the continuation lower. Like nothing was invalidated with that resistance. You remember what we were talking about with that just a moment ago? If you don't, well, then just rewind. We were just literally talking about a few examples. This is different, okay? And I'm gonna tell you why. So whenever we have a scenario like that where it doesn't respect that resistance, right? So like it didn't, you can clearly see how it did not just come up here, take this level. It didn't respect it and then just move lower. What happened here after it came up to that resistance? You see how it like exploded above it right here? See how it like exploded above that old high, which was resistance? Had that strong close and it continued to push up here. That becomes support now. It goes back to what I was saying at the very beginning. Resistance when broken becomes support going forward because it did not have a stop run signature. It did not respect that level. It was not wiki. It completely cleared it. It completely cleared that level right here. And whenever that happens, well, it becomes support going forward. Not always. Nothing's 100% in trading, guys. But that's the idea that you'll see that commonly happen here. And now some key tips here. Now this is going to help you out a lot. Okay. Some key tips here to make it higher probability. Like higher probability in regards to the respect that you're going to get to that level. That old high. Look for it to be in a discount marketplace as well. This is a very clear way because a question that I've gotten before is, okay, how do I decide though when it's cleared it enough, right? Because sometimes, you know, price might have a close above that level, but it's just kind of edging its head above it. It hasn't really cleared it, right? You know what I mean? I'm sure a lot of you guys know what I mean by that. But how do you know like it's really cleared that level? Here's an easy way to do it. Take your Fibonacci, find the most recent low prior to coming up into that high and cracking that high. Like for example, this is our most recent low, aka a what? A level of support. This is a level of support. This is an area where price failed to move lower. This is the absolute low that price hit before it failed to move and before it ramped up. The absolute low before we came up and we cracked that resistance. So what you want to do is take your Fibonacci from the absolute low to the absolute high that broke that level of resistance. And I want you to measure that price range. Make sure that that old high is in a discount marketplace within that range, meaning it's below 50% equilibrium. That's how you know it's in a discount. You take your Fibonacci from the low to the high, and if it's below 50% equilibrium of that price range, it is what we would call a confirmed, established level of support. Okay? Are there cases where it'll still turn into support if it's not in the discount? Absolutely. But this is like just a very clear-cut, simple, no thinking way to go about doing it. It's right there. It's no debate. There's no thinking. Right there. If it's below 50%, it has completely cleared that level. It is completely cracked it, and you can anticipate at this point that it's now going to serve as support because it cleared it. Now, another tip. I just gave you a golden piece of info right there. That's just a very easy way to go about doing it. Very simple way to go about doing it because it's cleared it at that point. There's no debate on it. Like, it's completely cleared that level. That's not some stopper and signature, guys, because a stopper and signature, it would not clear it to the point where it's now in a discount marketplace within a brand new price range. That's not a stopper and signature. So you can establish at that point that that's going to now serve as support going forward. Okay. Another key tip. For the highest probability levels. Now, this is where we utilize some SMC, smart money, which we already kind of are in this video, already have. But this is another key tip that's going to make these levels way higher probability. Now, it's not 100% necessary, okay? But if you want just a tip to make a higher probability for the best levels, look for that old high to be inside of a fair value gap as well. If you don't know what a fair value gap is, which I understand a lot of you probably don't, then I'm going to leave a link to a video on fair value gaps that I made in the video description. After you watch this video, go watch that video. But in simplest, just to sum it up super quickly here, 3 candles make the fair value gap. 1, 2, 3. And you can see the top of this first candle, the bottom of the third candle do not touch, and that leaves nothing but body in between, which is a imbalance, which is a fair value gap. That is an area that was not efficiently delivered. It's an imbalance. Okay, price was too fast, too strong, too quick. It did not get a chance to efficiently deliver that price action, which makes it an imbalance, which also means that it broke this resistance with strength, with velocity. That ain't some stopper and signature, not at all, not in the slightest. A stopper and signature doesn't have the old high inside of a fair value gap like that. There's no debate on it. It's a very strong push, a very strong break. That means there was a lot of buying interest at this particular point to send this higher. So now this old high is inside of that imbalance. It's inside of that. And what happens here is it's now amplified. It's now a more sensitive level of support. So we've already confirmed that we've cleared that level. It's in a discount. It's below 50% equilibrium. It's inside of a bullish imbalance. That's a sensitive area now. It's no debate. There's no thinking. I just gave you very clear rules on how to establish when resistance is broken and it's now support. Discount marketplace, inside the imbalance. That's what you look for. Again, how do you measure that range? You take the most recent low to the high. It's that simple. There's your swing low to the swing high. Discount marketplace, you can now anticipate it's going to serve as support, and it does, of course, right? It would be the opposite for a bearish. That's a bullish scenario, but it would be the opposite for a bearish scenario. So you would just look for, like, for example, instead of an old high right there, of course, you look for price to come down and put in a new low, right? And then you would look for price to have that big move lower through that low, just like you had the high right there. And what you would look for is you would look for that old low to now be in a premium. You would look for the fair value gap confirmation. You look for it to come up, retest that level. Then you could look for lower prices. Again, that's just a very clean, again, take your Fibonacci. So imagine this is the last high that was put in. This is that swing high level. Imagine with me that's that swing high level, right? And then this is the swing low. That's the level of support. It comes down, it cracks that support. What you do next? You measure that price range and you make sure it's pulled back above 50% equilibrium with that price range. Look right here, guys. Look how we got 50% right there. See how it trades above 50%, and then you have that old low in a premium. That's the key thing. You want to see it inside of a premium marketplace. It comes up and it tests that old low in a premium. Inside, also to make it higher probability, if you want, you can utilize the imbalance as well and make sure the old low is inside of a fair value gap. Very, very, very sensitive price point. I'm telling you guys, don't just take my word for it. Go study it yourself. You're going to see such beautiful fall through off these levels. Beautiful fall through, out of this world fall through. And then it sells off, and that's what you're going to be. Is it always going to work out? No. Sometimes it's going to go in the opposite direction. It's, again, guys, you're playing probabilities. You're not playing certainties, okay? There's no such thing as 100% certainty in trading. But if you utilize these tips, you're going to get better follow through more times than not. And that's what you call an edge. And that's all you need, okay? And that's how you would do it. So, yep, I think that about wraps up this video. Hopefully you enjoyed. If you did, leave a like, subscribe to the channel. I'll catch you later.